possibility for the market to push upward. Okay, now, and don't miss how important that is. So much of what we do as traders in the market relies on what we think is possible. Whether it's holding on to a trade or whether it's even getting into a trade. Let's go down to the hourly bar and just use the recent trading as an example. Remember, let's go back up to the daily. Remember, I've been talking about how if the market can get back into this area here, that you're probably going to see a fast move up. Now, why did I say that? I said that because if you look at the market, if we take off this recent trading, if we just remove all of this from the chart, and we're looking at this, we can see that there's just not a whole lot of trading up here. And remember, the market hasn't been here since 1991 to 1992. It has not been up here in a long, long time. So you have to remember that the market players, the traders, the big banks, the big hedge funds, big insurance companies, corporations, they don't really have a frame of reference. So it's not like the market has traded here before and we can say, well, you know what, the market's been up at it was just at $1.99. So fundamentally there's no reason for it to be up here. Traders really do have to adjust their thinking for the new price levels, but you've also got to realize that most people tend to be bullish. Okay? So that means they tend to think to the upside. In fact, if you think about your own trading and your own approach to the market, you tend to be more optimistic and think that the market can go higher than it is now. And you tend to think that if the market's moving down, it's not really going to go down much further. Okay, that is usually how people and traders in general tend to think. In the bigger numbers. Yes, there are some people that are just always bearish. They're always thinking that the market is going to go down. But the vast majority of traders, the bulk of traders, are going to be optimistic and they're going to look at the market like it's going to move up more than it already has. Plus, you don't have a lot of consolidation in this area. Okay? You see that the market came up and then down, up and then down. So traders didn't really have a lot of time to think about price in this area. Okay, they didn't have time to adjust. Now, it's my belief that consolidation areas like this big consolidation here represent traders getting used to the idea that the pound is trading at these levels, at 92.40 or 93.70 or even above 9,500. They're getting used to the idea. And the longer they get used to that idea, as long as nothing major happens fundamentally, you put that together with the idea that traders tend to be bullish, that's when you can get these price vacuums. And an easier way of looking at that is you see price vacuums where you don't see consolidation. So if you can draw a box across the market and you see a bunch of movement, the market probably is not going to move through there very quickly. What you're going to see is this, where the market gets in there and it hesitates. You'll see down bars, you'll see you'll see days where the market just goes sideways, that sort of thing. And all we have to do is look at this trading here. You can see that the market started to consolidate here, but once it cleared this area, and look at this trading, you had almost 400 pips before the market even took a breather. Okay? But that also was a good indication that the momentum was to the upside. And the market popped up and then started the consolidation process, moving back and forth, starting the sideways action, establishing support zones.